Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, December 22nd, Christmas week. Hanukkah's run its course. Um, it's 8:15 in the morning Mountain Time. I apologize for the scruffy face. We'll see if that survives the holiday period or not. There were some interesting things going on in the markets that you may not have picked up on, depending on your level of macro interest. One is the JGB market making new high yields overnight. This is being driven reportedly by concerns about the fiscal plans of Takaichi, although her approval rating remains exceptionally strong. So it's likely there will be expansionary fiscal policy. So that we thought was quite notable. One other thing you may not have picked up on, and something we've been writing about in the US, is the spread of the agency mortgage-backed securities to 7-year treasuries, sort of a benchmark for the duration of mortgage-backed securities, has been tightening fairly aggressively recently. There was a Bloomberg story. This is something we picked up on about a month and a half ago, that Fannie and Freddie have been aggressively expanding their retained portfolios back to activity they used to do before the global financial crisis, and that's contributed to that tightening. So that's an interesting market to watch, because we do need probably a mortgage rate to have a 5 handle in front of it to spark a little bit of a rebound in housing activity next year. So if we can get a little more movement in the back end of the treasury curve down around 4 or so, and get that spread to tighten to about 1%, you could get a 5 handle on mortgage rates. And so that would contribute to the so-called run it hot or pickup in growth activity next year. So setting all that aside, we released 2 notes late last week. The first one was our annual macro themes note. And rather than going through 3 to 5 themes this year, we went through one big theme that we think is crucially important. We titled it Reversing Financial Statism, Privatizing the Fed's Balance Sheet. And the idea is that, as some of the candidates for Fed chair have proposed, namely Kevin Warsh, the idea would be to shrink the Fed's balance sheet through bank regulatory relief, so that the banks could absorb the holdings and supply of treasuries rather than the Fed, and that would free up reserves. Governor Waller spoke about this late last week and said if we loosen regulations, then we don't need $3 trillion of bank reserves on deposit at the Fed, that the banking system could lend that money to the private sector. And so we went through the history of the Fed's balance sheet. We went through the history of bank regulatory relief, what happened in the 50s, what happened in the 90s, and what this could mean for the growth of credit and the growth of capital investment. And we'll just leave you with one interesting period, which is during the 50s, when we were in the early stages of an absolute productivity boom, suggesting there was ample investment available for the corporate sector. CapEx was decidedly weak, and we would attribute that to restrictive fiscal or restrictive monetary policy, and this really restrictive bank policy that prevented credit from flowing to the private sector, and really causing capital investment to increase. That loosened in the 60s, and we had a capital investment boom. Now, eventually we had an inflationary shock, but we think that had nothing to do with the supply side actions of the economy. Those were other policies that caused that. So the key is here to repeat what happened in the early 60s without making the mistakes of the late 60s from a fiscal policy perspective. So the note, really interesting. We're not going to put this one completely outside the paywall like we did with our annual Outlook note. So it's a reason to become a paid subscriber. This video, by the way, is going to go to both free and paid subscribers. We're only going to do one this week. So we then wrote a note called Asterisk Economics, because we wanted to put something out there to discuss last week's employment, delayed employment, and CPI reports. The bottom line here is, yes, there's questions about both of these reports, but the direction of travel towards higher unemployment, excuse me, key point of differentiation, unemployment is going up, and lower inflation are correct, notwithstanding all the criticisms of the way this data was collected. So first on um, the payroll report, there were three components to this that really shocked us. One was, or were concerning, I suppose. One was the increase in the U3 unemployment rate, which is now right in line with the Conference Board labor differential, something we've been writing about extensively. And we are going to get that labor differential for December tomorrow morning. So that'll be the key number of the week from our perspective. The big jump in the U6 underemployment rate to 8.7%. It's overshooting where the labor diff says it should be, more like 8.4. But nonetheless, that's gone up from 7.5 earlier this year, suggesting there are a lot of people working part-time who would like to be working full-time. So the demand for labor is weak. And then, of course, the sheer number of unemployed has gone from a little over 7 million in June to 7.8 million in November. Now, this all came out of the household survey, and there may be collection problems, but it's consistent with alternative measures for the labor market. And then the final piece was the Atlanta Fed released their wage tracker data last week. Late in the week, the overall wage tracker dropped from 4.1 in September to 3.8 in November. And it was driven by less skilled wages. The lowest income quartile wages fell from 3.7 to 3.5. Those have been falling relative to the highest income wages since January of 2022, and we think has a lot to do with the reason that President Trump got reelected. Paid hourly wages fell from 3.9 to 3.7, and service sector wages, which tend to run below manufacturing, fell from 3.8 to 3.5. Again, this suggests that the pressure on low-end wages, even with the big drop in immigration, has not eased and is a real point of concern here. We also noted labor market churn has collapsed. The QCEW data that determines, is used to reconcile the birth-death model, this overestimation of employment, came out on Friday morning as well. And that showed that we may not have quite as big of an annual benchmark revision, negative benchmark revision as first estimated, but that overestimation got larger in the second quarter, which you'd expect. After Liberation Day, we know demand for labor weakened. So we wouldn't get too carried away when we finally do get that benchmark revision in January. And it suggests maybe it wasn't 911, negative 911, maybe it was negative 750,000, because that overestimation actually got worse in the second quarter of last year, which is not covered by the annual benchmark revision. So bottom line here is the labor market is weak. Moving on to the CPI data, a lot of the criticism surrounded the rent of shelter measure, which has been overestimating employment all the time. So if you're arguing that they got October wrong in the way they did this, you're sort of making a silly argument, because if you look at the quarterly annualized rates of change, first for the apartment list measure, which measures new rents, in the 3 months ended November, the annualized decline was quarterly decline was 8.8%. For the Zillow observed rent index, which includes current rents, it was negative 2.2. That BLS measure was plus 1.4. So if you're arguing, it should have been 2 or whatever, no, it shouldn't be. There was a collapse in rents late in the year, or in that 3 months through November. And so you're kind of arguing a silly point. Same thing with respect to goods prices. If you're arguing, well, they just took the back half of the month when there was discounting, you think there'd be discounting if there was really a goods price, tariff-related price shock? No, obviously not. We've been arguing since Walmart reported their second quarter earnings. Walmart and Amazon have super sophisticated pricing models. They are the price setter in goods prices, and they're not raising prices because the conditions are not in place to raise goods prices. Bottom line here, the fiscal policy impulse is the antithesis of what it was in 2021. The monetary impulse is the antithesis of what it was in 2021. This was never going to be an inflation shock, and it was an adverse aggregate demand shock that slowed growth. So We'll see the GDP numbers tomorrow. We're still going to be skeptical of those. Looks like GDP was quite weak in the fourth quarter. As we've been saying, when all said and done, we're going to find out that pure domestic demand, PDFP, private domestic final purchases, actually ran somewhere between 1.5 and 2 in 2025, down from 3% in 2024 when fiscal policy was super expansive. Final point we made in that note was the budget numbers that underscore the points we just made. So again, you want to read all this stuff. You're currently a free subscriber. Become a paid subscriber. We'd love to have you. Barry Knapp from Ironsides. Merry Christmas, everyone. Happy Hanukkah if that's what you celebrated. Enjoy the holidays. Have a good week. Thank you.